Hello, hello, hello. How you doing today? This is Ed Beavers, and welcome to Ed Talk, where we talk about all things financial every Sunday at 5 p.m. Central, 6 p.m. Eastern Time. You know what? We're gonna have some fun today. We're gonna have some fun. We're gonna talk about some things that people don't always want to talk about, but you're gonna learn something today. Okay? I have my friend Catherine Okoroh on the phone today. And if you haven't um experienced Catherine, you are gonna experience her today. Okay? We are gonna be talking about credit. I have Catherine Okoroh. She is a vice president of lending services with guaranteed rate mortgage. Um and and again, we're gonna be talking about credit. Catherine, how are you doing today?
I'm doing good and I'm happy. Oh, I'm so loud. Can you hear it?
I can hear you. I can hear you. There you are.
Well,
I see you now.
hearing
I
is
see you.
never a problem.
So tell me about Catherine. Tell me about who are you?
Who am I? Oh my gosh.
Uh-oh.
Well, I'm gonna be brief. That is not usually who I am. But because I love this industry, but I love coaching and I love teaching. The biggest thing is I love it when I do something that helps somebody else. To sum it up, I'm a lender, but my greatest joy does not come from lending. It comes from the result of lending, if that makes any sense.
Yes.
So I'm all heart. I'm all like, I'm like auntie, cousin, sister, when I talk to people and I'm trying to help them. I try to connect and make sure that the information that I'm giving them is not just what they can find on the internet, right? That it is deep and meaningful and life-changing. That's who I am, Ed.
And Catherine, thank you for that. But I want to back up just for a second. Lots of my guests were expecting Sean Bacon. I just want to pray for Sean Bacon's family. He had to cancel today, but he actually will be on the show in a couple weeks. So I just want to take everybody just take a moment of prayer for Sean and his family. Okay, so Catherine.
Oh, I thought we were gonna pray, Ed.
No, we're not gonna pray, but just a moment of silence is fine. Okay, so when we talk about credit, Catherine, we want to talk about first. I want to say, what is credit? Tell me about what is credit, and why do we need credit? Let's kind of just jump right into it.
And what's so funny is that people say that that cash was king. I think the tables have turned and now credit is king. Everything that you get requires credit history and credit scores. Whether somebody is going to lend to you, like lend to you to buy a house, you need credit. And credit basically is like, I like to compare it to like a report card. When you're in school, you do well, you get A's and B's, and then other schools determine whether or not they're going to accept you by your grades that you got before. But that's kind of like credit, right? How you paid your bills before, somebody's going to determine if they're going to lend to you and at what cost. So credit is the thing that determines what you get on the other side, how you handled it, and what you do once you get it. So that's what I would say. Credit is that it's an ends to a means.
Now, I've actually talked to some friends, and they say, "Yeah, you know what? I don't need credit. I can just pay everything in cash. I just pay all in cash. I don't need credit. Credit's bad. So why do we actually need credit?"
Well, one is I have had plenty of people say they don't need credit. The problem is money runs out, right? Unless you just have a bottomless well that just never runs dry. You can only do as much as your cash can get you. I had an investor recently actually who his net worth was probably about $10 million. Okay. he was looking for a loan because he was running out of cash. And I think that's the biggest thing, is that if you're trying to build something beyond yourself, you're going to need the extension of something from another source. And usually it's going to be credit. So even though, and I think the reason why people are like that is because they don't want to have debt, which I think is very smart. But I think there's a way you can balance having credit and keeping your debt to a minimum.
See, that's actually, I try to tell people that. Now, when you have credit, we have a certain responsibility as a um um as as a borrower. So I kind of want to talk about that first. So I would say, and you could tell me whether you agree or not. You will tell me,
I do
right?
not agree.
Of course,
I do
you're
not
right.
agree.
Right. So, borrow only what you can repay.
Yep.
Okay, that's why I tell people: only borrow only what you can repay. Now,
But then how do you figure that out, Ed? Right?
right?
How do you know what you can repay?
Okay,
right?
tell me.
Well, one is, some people
talk about
have
that.
rules, right?
Mhm.
Some people have rules on, okay, if I have $5,000 in the bank, then what this says here is, okay, then I only borrow $5,000 because I can pay that back, which I think is a great philosophy. The problem is that something you may want to get may cost you $100,000, for example, like a house or a building, right? Or let's look, it'd be great to find a building for $100,000, but let's just say you found something and you need to borrow something, you can't pay that back. Then you look at what can you afford to pay monthly that you can make up, even if your current job situation were to change. I like to say, one, always keep 6 months of reserves. What that means is 6 months of your monthly expenses saved at all times. Everything, groceries, clothing, utility bills, rent, whatever it is you have, 6 months at all times. So that means if all of your monthly expenses come out to be $4,000, then you should have at least $24,000 at all times. At all times. So that means if you go buy something, you should have money left after that to pay all your expenses for at least 6 months so that you can figure out your plan B, right? But $24,000 sounds like a lot, right? Most people are not going to have $24,000 and then extra, right? The problem is, I think there has to be a mind shift and to think, there are plenty of people out here that earn enough money where they can save at least $500 to $1,000 a month. There's a lot of disposable income. The thing that I see a lot, because I've been a lender for 20 years, okay? I look at a lot of bank statements, and I'm not looking at them to see what people are spending. What I look for is when they tell me they don't have enough, that they can't afford something. I go through their statements with them and I ask them, is there anything that you've been doing or spending money on that you could cut out or cut down on? And usually it's actually eating out at restaurants. That usually is what it was. But now with the pandemic, that isn't so much. I've seen people save so much money in the last 6 months. And they're like, oh my gosh, I've saved $12,000. I didn't know I was eating out that much, at restaurants and stuff. So I think that if people just look at what they're bringing in and look at what they're spending, I do think that people can save enough where if they went to borrow money, they could have enough to pay it back. Look, keeping that 6 month in mind. I don't think that's a far-fetched goal. I think we need to raise the expectations on saving and not always try to bring it down, because everybody's used to living check to check. I'd like to get people out of that mindset so that we can really start changing some lives financially.
So I want to talk about these credit contracts. Okay, I'm always telling people, you get these credit cards. Nobody reads the contract. Nobody realizes that company can change your interest rate at any time during that contract, and is actually written in the contract. Yeah. So we have to get in the habit of reading all contracts. Reading.
Absolutely.
Okay, because even though you might start out at 5%, in a year or two, that may be it may be actually 12 or 13%, and you don't even realize because you're not reading the statements and you're not looking at the bill, and you're just paying the minimum amount due.
Okay, yeah, and you know what? Can I jump in real quick?
Sure,
I was just going to say that I was doing some research, right? Of course, I'm a loan officer lender, but I'm more than that. I think if I could go back to your original question
Sure.
of who am I or what am I, I'm more than a lender, right? I'm more than that, because the information and the things that I try to share with people come beyond, here's your interest rate, here's your loan program. Yeah, we do the down payment system. You know what I mean? Like that's other stuff, right? But the number one way that financial institutions, okay, make money are fees. And guess what? They make fees because we're not reading what the fine print says about those fees. Mortgages are different, right? Because everything is disclosed, you have to sign it, and the print is bigger. Let's just be honest, right?
Right.
But a credit card statement, they even changed the law where the font had to be enlarged so that people could see it. Because there was a time when the font was so small that people couldn't see what it said. And people fought. That's why IDFPR exists now. It said, hey, let's protect people. People need to be able to read this stuff. They have disclosure statements. The problem is people aren't reading it, right? So I think if somebody has a hard time understanding something, you can reach out to IDFPR. You can go to those credit contracts that you get, and you could call the number, and you can say, hey, in number 4, what does that say? What does that mean, right? You can get it translated by the person who provided it to you, and stay on the phone or in that chat until you actually understand, wherever you are, what that's talking about, so that you don't get caught paying fees just because you didn't understand something. Not all of us. I mean, I read stuff sometimes with some of this stuff, and I don't know what it means either. So it's good to just ask the question.
So, Catherine, how important is it to notify creditors if you cannot meet the payments? And I have payments.
It's very important. It's very important. Extremely important. Now, I'll tell you a story. What I did actually when I was in college, this is before I knew anything about credit. I tried doing that. I got a you probably know about it, a financial aid refund check. You might have heard about that before.
No, I think so.
I used to get the, if my mom watches this, she's gonna be like, you used to get what? But anyway, I used to get, don't send it to her either. But anyway, I used to get these refund checks of like $3,000 and $4,000, right? Now, I started trying to get a little bit responsible. So I remember I had this credit card, the first credit card I ever had, and I called them and I said, hey, I'm not going to be able to make my payment for a few months, but I want to send 3 months of payments until I can make the next payment. They said, okay. So I sent them $150 because in my mind, I was paying for the next 3 months. Okay. So I just kind of threw the bill in the garbage, like when it came, because I was like, oh, I paid for 3 months. And that's what I found out. I told them that, but I didn't know to ask, hey, how is this going to affect my credit report? So after that 3 months, when I was like, oh, it's been 3 months, let me look at my report. They showed that I had made a $150 payment, and then I was delinquent for the last 2 months. So you make your call to your creditor, but you have to know the questions to ask. One question is, if I'm having a problem, do you offer any programs or services, forbearances, or whatever it is? And then how will it impact my credit report? What will my credit report show if I don't pay this for 3 months? And how will it impact my interest? Does my interest double, triple? Could it change after that term? I think that we ask one question, and then there are probably a few others we should be asking. And that if somebody doesn't tell us, we don't know. And then we're like, wait a minute, we're caught like deer in the headlights because now our credit is ruined and we thought we were giving them a heads up that we couldn't. So it's extremely important, but I think you have to add those other questions to the scenario.
So let's kind of switch subject over to bankruptcy. Let's talk about bankruptcies, and a couple things I want to talk about bankruptcy. I want to talk about how long would it take for me to buy a house out of bankruptcy? One question, and then I also want to talk about what debt never goes away through bankruptcy. So let's just talk about both those things, if you.
Okay. Well, I'm not a credit lawyer or a bankruptcy attorney, but I can tell you what I know. Okay, about that.
Right.
One is that bankruptcy, as long as you've made payments for 12 months, and actually there are different types of bankruptcy. So I will go into that a little bit. And the one that would typically affect the consumer would be a Chapter 13 bankruptcy or a Chapter 7 bankruptcy. They are different. The Chapter 7 bankruptcy is the one that kind of wipes out everything and you don't have to pay anybody, right? And with the exception, of course, of student loan, right? It used to be parking tickets. I don't know if they changed that, but parking tickets are also something that you can't put in the bankruptcy because they'd like to get their fees. And then a Chapter 13 is after 12 months. As long as you can establish 12-month, on-time payments in your bankruptcy, and you have the credit scores that you need, you can purchase a home. You don't have to wait 5 years or 7 years or however long you're in that Chapter 13. The other thing is, if I could add to that, is what you really want to do after Chapter 7. Chapter 7's discharge a lot quicker than Chapter 13's do. Chapter 7 can be discharged in like 4 months or 3 months. It can be pretty fast. What you want to do immediately after Chapter 7 is start reestablishing credit, like right away. As soon as that bankruptcy discharges, you want to be on it. A secured card or becoming an authorized user with a parent or, a close relative who can help you reestablish credit. You want to start building. With the Chapter 13, I have plenty of clients who've had a Chapter 13 who have 700 credit scores and they have a Chapter 13 bankruptcy. So the reorganization of debt doesn't always mean that your credit scores have hit the floor. So you can purchase a home 2 years after discharge from a Chapter 7 and a Chapter 13. As long as you've made payments for 12 months, you can then purchase a home as long as you qualify, and that's with both of them. The other thing with the bankruptcy at Chapter 13 is that you do have to get permission from the bankruptcy trustee in order to enter into another financial agreement. So you want to make sure that you're on good terms with your bankruptcy trustee and that you're making the payments and that you're keeping record and keeping track on your own of your payments and not just relying on that source to provide you with the proof of your payments. So does that answer your question, Ed?
Yeah. And so going into that 13, let's just explain to them that that's actually a payment plan, right?
Wait, say that again, Ed.
Explain about the 13 and how that's actually a payment plan. And
yeah,
okay,
it's called a Chapter 13 is a reorganization of debt. So and actually, I'm glad you brought that up specifically because some people get duped, right? They're taught about doing a debt consolidation. And as a lender, we look at a debt consolidation the same way we look at a Chapter 13 bankruptcy. So just be mindful of that. Even though you don't have that bankruptcy word on it, it's still looked at as the same thing. But a reorganization of debt just simply means that there may have been a situation that happened in life. Maybe your income went down. Like, for example, with the pandemic, I've had plenty of clients that were contemplating, man, should I file bankruptcy or should I just kind of wait, weather the storm and see if I can figure this out? Well, that's an individual decision that you look case by case. But if you have the income and you can say, man, my bills are $1,500 a month. I'm a little short. I got about $1,200, and it's just tight. I can't, then you might want to consider a reorganization of that so that you can use that $1,200 and make all the payments and just get into an arrangement where they will accept that, and then it's negotiated within the bankruptcy, and then you can make the payments and pay off your creditors that way. So the reorganization of debt is different than a 7 that liquidates everything or wipes everything out. Did that answer that?
Definitely, thank you. So I want to move over to a subject that is
student loans.
That is like near and dear to everyone in America. Student loans. Let's talk about those student loans and how that affects what we can get, pretty much as far as our debt.
What you can use to get a home or to qualify for a mortgage.
Correct.
Correct. Yeah. So student loans, that's a tricky subject, but I will tell you this is where conventional credit comes in over FHA. Like there are really a few different loan types, right? There's conventional, there's FHA, there's USDA, and there's VA. Most people, especially in the Chicagoland area or urban communities, are going to get conventional loans and FHA loans. And if they're veterans, they're going to get VA loans, okay? When it comes to student loans, the reason why I mentioned the particular loan programs is because with FHA, we have to use 1% of the total balance as a payment when we're qualifying you for a mortgage. That means if you owe $70,000, we have to use a $700 payment, even if your payment is only $100 a month. That's FHA. Conventional, if you are in a payment plan, what we call, or what's referred to as an income-driven repayment plan, we can actually use that payment as the payment to qualify you. I have doctors as clients. I have teachers as clients, right? I've seen student loans from $3,000 to $350,000. Okay, that could either you're buying a home or you're not, right? But with a conventional loan, I've had doctors who have $500 a month payments, and they go and buy a house, and and they're fine. But that's only if they could get a conventional loan. If you're kind of limited with just FHA, that means I'd have to use a $3,500 payment. That might be all of the disposable income you have. That means you need a co-borrower. So student loans has really kind of caused some people to kind of put their home buying plans on hold. The biggest thing I would say is, because now that rule is, you really want to work on having conventional credit so that you are not necessarily limited, so that you can still purchase a home.
So let's move to a subject. Let's talk about child support.
Okay, what do you want to know about child support?
How was that? I don't have anything.
That was not.
This is I'm asking for a friend.
Okay.
You're always asking for a friend, right? So,
hypothetical scenario.
Right. If I have child support, and then are you actually looking at the payment plans on the child support? Is there anything about the child support payments or record that could affect us buying a home? I'm sorry, my friend buying a home.
Well, tell your friend you need to get caught up to take care of his
kids. Catherine, that's a whole different show, and I think the super producer just had a show like that. I think she had a show that's gonna I think what do you have, 14 kids on there? 15 kids, but that's a different day. We're talking about people that pay their child support on time. Yeah, we're talking about child support.
So, but I can have a twofold conversation with you about child support. Your question is basically what happens and how does that affect you getting a home, right?
Yes, ma'am.
I also want to add to it, if people are actually receiving child support, like how we can use that as income.
I like that.
Okay? So there's a twofold to that. So for the one who's paying child support, right? You want to make sure that you are paying it. We are looking at pay stubs to see if it's coming out of your check. We are looking to make sure you are not delinquent in child support, because lenders do not like to lend when you have a negative, when you owe child support. You actually would not be able to purchase a home if you are delinquent on child support. I had one gentleman, and he was a barber. He was making about $90,000 a year as a barber. Cash business. He owed child support of over $45,000. And then he explained to me why he had a cash business. So he got a cash business because he couldn't prove that nobody could prove really what he could pay. So he said he would always give the mom cash. In a situation like that, where men are afraid maybe of paying that or whatever, and how that would affect them in buying home. One, he didn't qualify because that cash he was making, he was not filing taxes, right? But he was paying. It's just that there was no record of it from tax returns or anything like that. So with buying a home, if you have a cash business and you're paying child support, then, and you have an agreement like that with the mom, then take that to the court and say, hey, I've been paying, and just work that out, because it will stop you from being able to qualify. It would hold up other part, of your life financially. On the flip side, for the mom who maybe is getting child support, we want to be able to prove that the mom is actually receiving the child support. I actually have a situation right now where a client gets child support, but the ex-husband, she gets maybe, between $400 and $600 a month, but he gives her, $50 cash, and he'll buy the kids clothes, and he kind of pays it in like doing other things. Unfortunately, we can't use that income because we can't verify it. So it's important that it's able to be verified in order for it to be used. And if it's a situation where the person who's paying it is nervous about, if he's making $90,000, he's probably concerned that, well, he actually told me this, concerned about being able to support himself because of what he would have to pay in child support. that's another conversation. But in terms of the financial piece of it, it's better to be on the up and up, right? And figure out some way to document what you can pay and all that. Like go through that and take care of the kids financially, and then work something out with the mom that makes it agreeable for both people. Because $40,000 in owed child support means that he hasn't paid on the record for well, yeah,
ever.
Yeah. So that wasn't a good situation, unfortunately. But I was probably the fourth lender that he spoke to. We all told him the same thing.
So here we go, Catherine. Credit Karma. Credit Karma. I looked at my Credit Karma today, and I liked it. I liked it.
I'm sure you did.
I like my Credit Karma score. But then when I called the lender, they're like, no. So let's talk about Credit Karma versus FICO.
Well, I don't know if you see my little videos that I've been doing lately. I get so many people that want to argue with me about their credit score because Credit Karma said their score was a 798. And then when I get their credit report, it's a 614. Nobody wants to be in that conversation. I've had, the birds chirping in the background. When you say something, they're like, quiet. I've had people argue with me and say, I don't understand. Why is it, I get it. So Credit Karma is, a consumer-based, program that service rather that provides you with credit scores. They are not FICO scores though. Actually, if you read the fine print, I've actually gone to the Credit Karma site and said, hey, everybody uses it. Maybe I should use Credit Karma. Then I went and I read it, like you just talked about. I read and I saw that they use a different algorithm to determine the scores. And I said, oh, well, this isn't a FICO score next, right? I looked around, there's Credit Sesame. I mean, there are hundreds of credit services, out there that offer scores, but they are not FICO scores. MyFico, MyFico, actually gives you FICO scores, the FICO 08, 07, 05, 06. They actually give you all the models of FICO scores with the algorithms, and you can click and pick which score you want. If you're trying to buy a car, you click on auto scores, and then your auto scores pop up. Or you can get your auto score. You can click on mortgage, and you can get your mortgage scores. And actually, it's perfect timing, Ed, because I had somebody today. Her credit score was a 639, and I said, "Man, you need a 640." Well, she went to Credit Karma. She said, "I don't understand." Her Credit Karma score was a 676, and she said a 676 and a 660. I don't know why you got a 639. I said, "Well, that's not a FICO score." Blah blah blah. She went and got a MyFico account and pulled it up, and it said her middle credit score was a 640. I was like, okay, let's check and see, right? I pulled her score. It was a 644. So her score was like almost dead on with the MyFico.
Now, what's that? Is you said it's myfico.com? Is that what it is?
MyFico.com. I don't get paid from them. This ain't no pitch, I looked. I mean, if you look at credit scores online, this is exactly what I did. Yep, myfico.com. If you look at all, you can see all of these Equifax, TransUnion, all of them offer scores, and some of them will give you FICO, but they give you one score. You can't do anything with one score. You're trying to figure out what is your middle score, what's all three, So myfico.com has been extremely informative, and now I have 50 to hundreds of people right now that are on MyFico monitoring to see when their score is going to hit whatever number they're aiming for whatever program they're trying to get, wherever they are, and they're texting me their scores. They're like, hey, my score is this. I'm like, let's do it then. I had another one the other day, 6 months ago, she had her score was a 602. She pulls up MyFico, she goes, hey, Catherine, look, and she sent it was 667. And so she's like, hey, didn't I just need a 660 or something? Yes, you did. So now she's like, boom, and it's dead on. So every single time, guys, MyFico is within 5 to 7 points of the actual FICO score that we get.
Now I'm gonna tell you a funny story. So I want you to talk about the three credit bureaus, the Experian, TransUnion, and Equifax, and then I'm gonna tell you a funny story. But go ahead, explain those, please.
Okay. So now you mentioned those, but I want to tell you something that people should know about them. People always ask, why are their scores different? Okay. People always want to know, well, how do they get 3 scores, right? And I'm going to tell you a couple little tips that I use and that I have shared with people for years. One is when you get a credit card, if you don't read it in the fine print, or you just want to call and ask, you should ask them which credit reports do they report, which bureau do they report to. Experian, TransUnion, and Equifax are actually data processing companies. That is what they are. So the algorithm for the FICO score was created like in the 70s. So the FICO is an older algorithm that's been used for many years. And lenders said, "Man, this FICO thing is pretty good. Let's keep going with this." TransUnion and I can't remember which other bureau got together and formed Equifax, or they got together and formed Experian. I can't remember which two, but they're mergers of each other, so they're all kind of connected. At one point, I used to think that credit bureaus were like government agencies. That's just because I didn't know that they're actually independent companies that are data processing. And what they do is, let's say I'm a creditor and I want to, report who's paying and how they're paying. Well, I'm going to say I want to use Experian because their reporting is more accurate. So let's say I'm bank card A, okay? Bank card A says I'm using Experian, TransUnion, and Equifax because I'm going to report to all three just to get a good average, right? We just want to kind of make sure lowest high, it should be more fair, right? But then credit card B is like, I'm only going to report to TransUnion because TransUnion is free. TransUnion, because I've been a customer with them for so long, I'm going to use TransUnion because they only charge me X amount versus me paying Experian and Equifax. So you, as a consumer, when you get your credit report, you are the subject, you are the outcome of a business decision from the creditor. So if you don't ask the question, you might say, "Man, I've been building credit for a whole year or 2 years, and you got one credit score, or you got two credit scores. You don't have the benefit of all three because you didn't know that your creditor was only working with one of the agencies." So it's important that when you're trying to establish credit and build credit, you understand the importance of having credit with each bureau being reported so that you have the opportunity to have the best possible score that's being used. Does that answer your question?
It does. It does. So when folks say the middle score, they don't actually mean the one in the middle, do they? They actually mean
they mean the one
now. So can I like move them around and make the worst score in the middle?
No. It actually is, TransUnion has been known to give the higher scores. Mm-hmm. And I think Experian has been known to give like the lower scores. Excuse me. But it's not really anything out of the ordinary. It's just like I just told you, it's who the creditor is using to report their account payments of their customers, right? When you get the three scores, your low score, your high score, your middle, the lender, we're going to just pick the one in the middle. We're not adding it up and averaging it. We're not doing any of that. We're just picking that score in the middle. The other thing that's important for you to know, though, is when you use, like, let's say you're getting insurance. Ed, you know about that.
I sure do.
Right? I mean, yeah. Let's say if you're going to get insurance, right? And Ed, I want to ask you a question because I don't know a whole lot of stuff. Is that if I want to get insurance with you, do I say, do you pull credit scores? You get credit reports, right?
Yes, and that's great because that actually goes into the next question that we talked about, Catherine. We pull what's called a soft pull, and then so that goes. I mean, you are right on target. You are right on target, Catherine, with these questions. But I want to stop and make a quick break to say you are joining us with Catherine Okoroh on Ed Talk, and we're talking about all things credit today. And we're on Facebook Live as well as IntellectualRadio.com. You can call in and ask Catherine a question at 708-223-8953. She wants to ask your question. This is 708-223-8953. But we're going to go back to these soft pulls and these hard pulls. Yes, most insurance companies do look at your credit, and it actually does affect your rate. But kind of go on.
It does affect your rate? Definitely. Okay, so my specific question now I'm going to put you on the hot seat. So if I'm shopping for insurance for my house, let's just say, for example, do you use all three like we do as a lender, or do you just use like one?
We have our own little scoring system, and most companies have their own scoring system.
Oh, so is it something that a consumer can have access to?
It is credit based, and they actually can get a letter for it as well.
Oh, really?
Catherine, hold on just a moment. We're gonna take a
Okay.
call.
Okay.
Caller, what's your name and where you're calling from?
Veronica, calling from Chicago.
Hi, Veronica.
Hi.
Do you have a question or a statement?
No, I had a question.
Great. Yeah.
Hi, Catherine. Thank you for the good information that you've been providing. I had taken a credit course before, and the instructor told me that for every credit range, there could only be so many people in those credit range. So, for example, if you were trying to get to a 700 credit range, you might pay all of your bills on time and never accomplish that because, behind the scenes, there are only a certain number of spaces allowed for people in that credit range. And I thought that was interesting. Do you know anything about that?
I do not. And wow, that sounds really complicated to, because how would you know what people are going to pay and when they were going to pay? And, I have never, I've been looking at credit reports for 20 years, and I have never seen a person because I look at credit reports so much, I'm usually able to see where they will land when they do certain things, right? Like if they pay things down, I look at their utilization, I look at late payments, delinquencies. I have never seen somebody not do all the, keep the balance low, pay it on time. I've not seen people do exactly what we all know people should do, maybe don't, but should, and not get to the 700. I have not seen that. I mean, if there is something going on behind the scenes, they're very good at it, because in 20 years of looking at credit reports, I've not seen somebody's score be able to be impacted if they did the things that, we all know they should do.
Okay. Thanks so much, because it's always such a mystery how many points you gain for doing this versus how many points you lose on that, let's say, same account for a mistake. So,
to Veronica?
Yes.
To your question, I will say this. I have seen mortgage rates drop a score 80 points, and I have seen and recent. Now, what I've seen is that the more recent the late payment is, the more impact it has on the score. And the further out it is, the less impact it has. So when you have people, I mean, man, this conversation could really go, a lot of places. But I will tell you that if the root behind the question is, can I get to 700? If I do, absolutely. I mean, I have never seen anybody not get where they're trying to get if they just implement some of the things that, paying down, setting things up on auto pay so they're no late payment. I've even seen people have things removed from their credit reports, like a mistake or something like that, and I've seen their scores shoot up. I had a couple clients that had mortgage rates that were mistakes by the mortgage company, and their score went right back up to 80 points that they lost because of that late payment that was reported. So I've seen a lot of things in the time that I've been looking at credit reports as a lender, and I have never had a case where somebody didn't do something and they didn't get the result.
Well, thank you. Caller, what's your name and where you calling from?
Hi, I'm Yvette from California.
Hi, Yvette.
How you doing? I have a question about debt consolidation and the chapter, was it chapter 13? So if you're already in the debt consolidation, what should you do? Should you continue with the debt consolidation, or should you try for the chapter 13? What should you do?
I don't know if you should do anything if you're already in the debt consolidation. Is there something that you're trying to? Is there something else you're trying to figure out with that? But they're basically like the same thing.
I'd like to buy a house eventually, in a year or two, about 2 years. So that's what I'm wondering.
No, a debt consolidation from a lending standpoint is looked at just like a bankruptcy. So as long as you're paying the debt consolidation on time, then, sometimes they want you to have 2 years of on-time payment history with a debt consolidation. but it's kind of looked at like the same as a bankruptcy. You don't have to go from one to the other to make a point. If there are any finite differences in that, that would be a bankruptcy attorney kind of question.
Okay.
Thank you.
Okay, thank you.
So
I wanted to get it. Let's go back to the soft and hard pull. What's the difference? What's the difference?
Well, I will tell you, if you come to me to try to get pre-approved, it's definitely going to be a hard pull. My thought process is this: if you go to get an extension of credit, like a credit card or money, like a lender, like myself or whatever, it's going to be a hard pull. If you're going to like you, Ed, with insurance, you guys are a soft pull, right?
Correct.
Okay, you guys are a soft pull.
Correct.
And you're not really giving credit. You're insuring, but you're not like lending money or anything like that, right? And I know for a fact as well that like if people wanted to go to like a housing counseling agency, maybe they can pull your credit report, and it's a soft pull. I used to be a financial coach, and I would pull credit reports, and they were soft pulls. And it's because I was not in a place that was lending. I was not in a place that was extending credit. I was just helping and educating and stuff. So it was a soft pull, was not a ding, and it did not show up on the credit report. So a soft pull does not impact your credit report. It just gives the person looking a sneak peek or a view to see kind of where your credit is. And a hard pull is like an extension of credit. A credit card would be hard pull. Unless they state that it's a soft pull, I would expect it to be a hard pull when it comes to like a credit card or auto financing or something.
Okay. Let's talk about, let me go back to the soft pull and the credit card. So just audience, just so you know, credit card companies do pull your credit. They actually look at your credit every month to actually see what you're doing with credit with other companies. So say you got a Visa, and this Visa's at you have $100 on this Visa card that you only use, and then then you start spending on the other credit cards. They're actually looking at those other credit cards also, because if you start spending too fast, they're gonna say, whoa, what's going on over there? And they're gonna either raise the rate or they're gonna close actually drop your line of credit. So watch out. If you have 3 more credit cards, everybody's looking at your credit all the time. They're actually looking at it every month. They're always looking at it. It actually never stops.
Wow, no, that's good. That's good intel. I didn't even aware of that.
So let's talk about these. Not the student loan. Let's talk about. Hold on, give me right here. And we had talked about this earlier, Catherine. We're going to talk about. I had it right here and that was gone. What did you do, Catherine? Come on, Catherine, help me out. Credit disputes. Credit disputes.
Well, one, people should dispute things that are wrong on their credit report. Absolutely. But I will tell you something that I've seen a lot. Credit repair is very popular, right? And credit repair companies are. I mean, they do what they do, right? I've had people that said, man, they've got busy schedules or whatever, and they're like, hey, you got any credit repair referrals, because they don't have the time. When you've got stuff going on with your credit, it's so time consuming to really go through all that. But I will tell you this: if you choose to use a credit repair company, you should know what they're doing. And what I've seen is, not all the time, because there are some credit repair companies actually that do know credit, and they are actually legitimately working through different challenges that you may have had dealing with a certain creditor. But if we just want to talk about just dispute everything, I think there's a part of the Fair Credit Reporting Act, the law, that says that basically if you can't verify something within 30 days, it has to be removed from your credit report. That is that line in the Fair Credit Reporting Act that a lot of credit repair companies kind of use as their like go-to. And so rather than really look and legitimize the accounts, they just dispute everything. And if the company's gone out of business, if something's happened, guess what? you kind of luck out and a few things get removed and you're like, wow, this was amazing. The reality is you could actually dispute things yourself for free that are legitimately errors, or if it can't be verified. If the information cannot be verified, you can't be penalized because that company no longer exists or something like that. So I think it's good if people are going to dispute things that they actually, if they're going to use a credit repair company, that they make sure that the disputes are valid and not frivolous. The other thing is, as far as, from a lending perspective, on a credit report, if you have open disputes, you need to resolve them depending on what kind of loan you're getting. So you could have some disputes out there kind of hoping that they do whatever, but it could hold you up from being able to, purchase a home. You have to actually resolve it. And resolving it doesn't necessarily mean you have to pay it, but it does mean that there needs to be some kind of solution in place that you and both the creditor have agreed on, whatever that might be, but your credit report cannot show an open dispute. That means that could potentially come back and become a judgment. So, that's why lenders really are hesitant about you having open disputes, because I did have a client who had an open dispute. We were in the middle of doing a loan for her. And she, she had had it for about 3 or 4 years. She had never dealt with it. And it says she owed $696. So I said, oh, well, if you call them, maybe, whatever. Because I guess she'd never talked to them before, they said, oh, we finally found you, kind of thing. And they would not settle with her. As a matter of fact, they said, and by the way, you owe us $4,900 because here are all the fees, and turned it into a judgment. So needless to say, she never closed on her home, but it's because that open dispute turned into a judgment. So that is why having open disputes or just disputing everything can cause you problems when it comes to purchasing a home.
So, Catherine, we have a question in the chat room. Hi, I'm Gail from Chicago. I have a question. I was under the impression that the highest credit score is 850. I've now heard that there is a 900 credit score. Is this true? And what is the difference?
Well, the 900 credit score is probably like an advantage score or Vantage score rather. Vantage score, there are different algorithms out there. The FICO score, the actual highest FICO score you can get is an 850. There are other algorithms out there, and they probably go to 900. But I'll just be very frank. There are people that are like, I want a 900, right? Because they want to be the best. They want it all, right? But I will tell, I will not, that's like my mom, right? She's like, no, 825, no way. I want 850, So there are, I call them overachievers, But in the lending world, right? Once you have a 740 and above, it's like all the same category. There's no like, I got an 825, your rate or whatever is going to be better than the person who has a 740. So yes, there are different ranges, and it depends on the algorithm that's being used. But as far as a lending standpoint is concerned, it's 850. In 20 years, I have never seen an 850. The highest credit score I've ever seen is like an 823. So.
Okay, here we go. We are rolling, Catherine. I'm trying to get all this in 50 minutes. It's just so much. Let's go to authorized user accounts.
Okay.
That's a big topic that we talked about earlier. And tell them what an authorized user account is, how you use them, how they're used with kids and your family. Just kind of give us an update on that.
Well, I can tell you with an authorized user, for example, I'm a mom and my kids aren't 18 yet, but let's say my son or daughter was 18 and I wanted to set them up for success, right? Remember earlier we said not cash is king, but credit is king, right? Depending on what you're doing. So I could call my credit card company and say, hey, I want to add this person or whatever and add them to my card. And then that would help them to establish credit. So an authorized user account, actually, and they don't even have to have the credit card. I don't have to give my son or daughter the credit card. They don't have to use it. It's based on my payment history and how much I owe. So it is completely on the person who is the primary on the card. The authorized user is just the person who's given access to the card, but they actually don't even have to use it. So it's a great way really to help establish credit for like your kids or family or whatever. So that's it. And then from a lending standpoint, I know I have had clients that I've worked with off and on at different times, and I said, hey, what happened? Or I look at credit reports all the time and I'll see that they have three borrower accounts, which is basically 3 accounts on their own. And I'll see that they're an authorized user on their spouse's account and their credit score is 750. But when I really look at the history, I see that a lot of the credit has been established by the spouse and not necessarily by the person in question. But I don't start deducting the scores or anything like that. I just look at what it is. And then I look at their score and I look that they have great history and we move on. But I think a lot of people can benefit from, if you have a spouse who has had more credit history established, that you can add them as an authorized user and kind of help each other to build up your scores. So,
man, you, Catherine, you covered so much today. So I want to tell people how they can reach you. And is that the right number up there? Look at that. How it just popped up out of the blue. Catherine Okoroh. It looks like it's 708-351-7268. That's Catherine Okoroh at 708-351-7268. And she's the vice president of mortgage lending for Guaranteed Rate. Oh, and there was a great point made by Laura Allen. She actually gave the downside of a authorized user account. She says that the downside is that if the owner doesn't make payments, then the authorized person also gets negative credit.
Yes, that's true. That is true. So, but guess what? She can have it removed off her credit report because it's not her account.
Oh, okay. So we have another question. They're actually coming in, Catherine. We only got a few minutes. So hey, Ed. So John Scott says, "Hey Ed, are the credit limits a questionable item? Say 2,500 versus 15,000, and getting a Hyatt credit approval such as American Express, Black lines of credit that are not attached to real estate." I'm not sure how to. Did you understand that question?
Like, does it affect them if they have a high limit versus a low limit?
Well, are the credit limits questionable items and getting a credit? John, you might have to call in on that one. 708-223-8953. On that one. So here's what we're gonna do.
Yeah, we're gonna have to do a part 2.
Yeah, we're gonna do a part 2. There's just too much to handle in 50 minutes. But my father said that, okay, this is the favorite part of his show. Willie Beavers, he said last week that I did not say his name, and he called and said to me, Ed, you didn't mention my name, okay? So Willie Beavers, right? Willie Beavers, you hear that, Willie Beavers? So this is the part of the show that I call Know Your Guest, okay? So Catherine, all I'm gonna do is I'm gonna give you 2 choices, okay? You only get to choose one, all right? So we're gonna start off. Smokey Robinson or Barry White? What's the problem? That's like a hard question.
I can't say neither, right? Okay. Smokey Robinson, because Smokey Robinson is like a Barry White's like, okay, Barry White. What?
Catherine.
Like, he's the one with the cool wine voice, right? Like,
yeah. This is a very serious question. Mrs. Okoroh. Okay. I'm not gonna even say very well. Okay. Michelle Obama or Oprah?
Michelle Obama.
Okay. Prince or Michael Jackson? Oh, here we go.
Michael Jackson.
Michael Jackson. Well, thank you, Catherine. You said what? You get a prize? You got a prize, yeah. You get a prize.
You play me a song or something?
Do you get a what?
I said, you gonna play me a song or something?
Yeah. Here it goes. No, joke. I just want to say, Catherine, thank you so much for Thank you so much for coming on the show. This is great.
No problem. It's my pleasure. Glad I could be here. Thanks for having me.
Oh no, you know you make me laugh every time I look at you. You start laughing because Catherine, she tells so many jokes all the time. I thought I told jokes, but I have nothing on Mrs. Catherine Okoroh, and I want to thank you again and for being on another episode of Air Talk, which is on Intellectual Radio. We come on every Sunday at 5 p.m. Central Time and 6 p.m. Eastern Time. I just want to say again, thank you and good night.
Good night. Thanks, everybody.